If tomorrow you open your bank account and realize that your savings have almost no value, what would you do? This is not an imaginary question. In economic history, this has happened more times than we think. Not in small countries or in distant eras, but in economies that were once considered the most stable and civilized. And what is worth noticing is that when a monetary crisis happens, some people lose everything, but others are almost unaffected. The important question is not whether they were smarter or luckier, but that they held different kinds of assets. Let us go back to a very famous story in economics. Germany in 1923, that was the period of hyperinflation of the Weimar Republic. One of the most severe monetary crises ever recorded. Prices increased so fast that money lost value by the hour. A loaf of bread could cost a few hundred marks in the morning and millions of marks in the evening. People had to carry wheelbarrows full of paper money just to buy food. In that situation, millions of middle-class citizens, people who had spent their entire lives saving, suddenly became completely poor. Imagine a banker in Berlin. He had worked for 30 years, accumulated salary, bought government bonds, deposited savings in the bank, and participated in a pension fund. By every standard of that society, he was a careful man and responsible with his finances. But in only a few months of 1923, all of that wealth almost disappeared. Everything was priced in. Marks a currency that was losing value at a speed no one could imagine. Meanwhile, about 40 kilometers from Berlin, a wheat farmer lived a completely different story. He had no bank account, no bonds, and did not understand much about financial markets. But he owned land and grew food. When hyperinflation happened, the value of food increased every day. People in the city were willing to trade valuable belongings, pianos, fur coats, even family jewelry, just to get a few sacks of flour or a pig. In a short time, that farmer became richer than ever. The same country, the same crisis, but two completely opposite outcomes. Stories like that are not exceptions in economic history. In fact, they repeat with surprising frequency. If we look back at major monetary crises in history, from the debasement of silver in the ancient Roman Empire to the paper money crisis during the French Revolution, to hyperinflation in Germany, Argentina, Zimbabwe, or Venezuela, we can see the same pattern appearing again and again. When currency loses value severely, some types of assets are almost wiped out, while other types of assets become extremely valuable. What is interesting is that the assets that get destroyed are often the very things considered safe during stable times. Savings accounts, government bonds, fixed salaries, or pension funds, all of these depend entirely on the strength of the currency. When the currency loses value, their value disappears with it. In monetary economics, this is a very important principle that is rarely mentioned. Money is not a permanent entity. Most currencies in history eventually lose significant value or disappear completely. This does not mean every monetary system collapses immediately, but it shows that monetary stability is often only a phase in the long cycle of economic history. For example, if we look at data from the past century, the purchasing power of many major currencies has declined significantly over time. This does not always happen in the form of hyperinflation, like in Germany in 1923. But the erosion of purchasing power still occurs quietly. In economics, this is called long-term inflation, a process in which the same amount of money buys fewer and fewer goods over time. This leads to an important question that very few people seriously think about if history shows that monetary systems can lose value or even collapse. Then what types of assets are actually able to survive through those periods? Economic historians have studied this question for many decades. When they compared monetary crises across more than 4,000 years of history from ancient times to the 21st century, they discovered something very remarkable. Although the historical context changes, technology changes, and the names of assets also change, the nature of the assets that are able to survive crises hardly changes at all. In other words, in most monetary collapses, wealth does not disappear. It simply shifts from one form to another. Value moves away from assets that depend on currency and flows into assets that have value independent of the monetary system. This is exactly the key point that many people overlook when thinking about personal finance. Most of us are taught that safe assets mean putting money in the bank, buying bonds, or holding cash. These pieces of advice are completely reasonable during stable periods. But history shows that when the monetary system faces a serious crisis, those very safe assets are often the most vulnerable ones. Part 1. Physical assets. Things that exist outside the monetary system. If you carefully observe monetary crises throughout history, you will notice a very clear pattern when currency begins to lose value severely. Society does not stop. People still need to eat, still need shelter, still need energy to survive. And because of that, assets connected to those basic needs are usually the first ones to keep their value. In economics, such assets are called physical assets with intrinsic value. Their value does not exist because of a number on a bank screen, but because they directly serve real human needs. When the monetary system becomes unstable, society often returns to these real value assets. In history, 3 types of physical assets have repeatedly proven their ability to survive major crises: productive land, gold, and real estate. The first asset, and also the oldest one, is productive land. Not just any piece of land, but land that can create real value: farmland, land with water sources, land with natural resources. The reason is simple. When money loses value, the monetary economy may become chaotic, but the need for food never disappears. A family still needs to eat every day, no matter whether the currency is rising or falling in value. This explains why during the hyperinflation in Germany in 1923, many farmers suddenly became people with real economic power. While the middle class in the cities watched their bank accounts become meaningless, those who owned land and produced food held something that everyone needed. They could demand payment in gold, foreign currency, or even goods. Their value did not depend on the mark, but on the food they were able to produce. A nearly identical pattern happened in Zimbabwe during the monetary crisis of 2008. When the local currency lost value by millions of percent, people who owned farmland or livestock were still able to trade their products for the things they needed. Meanwhile, those living in cities with savings in the bank almost lost the ability to buy food. The second physical asset has an even longer history: gold. Many people now think gold is only an investment tool, but in economic history, its real role is different. Gold does not exist to get rich quickly during stable times. Its main role is to become a reserve form of money when trust in paper currency weakens. There is a very simple reason for this. When a currency loses value too fast, society still needs a medium of exchange to keep transactions going. For thousands of years, people have often returned to gold because it satisfies 4 important conditions of money it is easy to recognize: divisible, easy to transport, and cannot be printed by the government. During the French Revolution in the late 18th century, the government issued a type of paper money called assignats. At first, people trusted this money because it was declared to be backed by assets. But when the government began printing more and more to finance spending, its value collapsed quickly. In just a few years, the paper money lost almost all of its purchasing power. Those who moved their wealth into gold early were able to preserve their value, while those who continued holding paper money suffered heavy losses. One interesting detail is that even in the modern financial system, central banks still hold gold as part of their strategic reserves. This is not a coincidence. In periods of monetary instability, gold often plays the role of a neutral asset, something that countries can trust even when confidence in paper currency declines. The third physical asset is real estate. However, real estate protects wealth during a crisis, not because housing prices rise on electronic market boards. The deeper reason is that real estate is a physical asset that cannot be printed. To build a building, you need land, materials, labor, and time. When inflation rises, the cost of all these factors rises as well. During the period of hyperinflation in Germany, many buildings in Berlin were priced with enormous numbers and marks. But those numbers did not mean much, because the currency itself had lost value severely. What mattered was that when the crisis ended and a new monetary system was established, those buildings still existed. They could still be rented, still generate income, and still hold real value. A similar phenomenon happened in Russia after the collapse of the Soviet Union in the early 1990s. When the ruble lost value sharply, many people realized that the apartment they were living in, sometimes given for free during the previous era, was actually the most valuable asset they owned. While savings in the bank evaporated, the apartments remained and became the foundation for the financial recovery of many families. The common point of these three types of assets, productive land, gold, and real estate, is that they exist outside the monetary system. Their value is not created by a decision of the central bank or by a number in a bank account. Their value comes from the fact that people need food, need shelter, and need a reliable medium of exchange. However, physical assets are not the only group capable of surviving monetary crises. In many cases, some other types of assets adapt even better to high inflation environments. These are assets that not only exist outside the monetary system, but also have the ability to adjust their value when the currency changes. Part 2. Economic assets. Things that can adapt to inflation. If the physical assets in the previous section survive because they have value independent of currency, the second group of assets survives because they have the ability to adapt to the loss of currency value. In economics, this is related to a very important concept that is often ignored in personal finance pricing power. When inflation happens, the price of everything begins to rise, but not all businesses have the ability to raise prices at the same speed. Some companies are stuck in long-term contracts with fixed prices, or they depend on non-essential consumer demand. When costs increase but selling prices cannot rise fast enough, their profits are eroded, and eventually they are forced to shrink operations or go bankrupt. In contrast, there is another group of businesses that almost always survives periods of high inflation. Their common feature is that they produce or provide things that society cannot stop using. No matter how the economic situation changes, products such as food, electricity, energy, medicine, or fuel belong to this group. When input costs rise, these businesses can adjust their selling prices almost immediately because demand for their products can hardly fall to zero. A very clear example appeared in Brazil in the 1980s, when the country went through a period of extremely high inflation, at times reaching thousands of % per year. In that environment, many companies could not survive because they could not adjust their prices as fast as their costs increased. But supermarket chains and producers of essential consumer goods adapted relatively quickly. They changed prices on store shelves many times a day, directly reflecting the inflation that was happening. Thanks to that pricing flexibility, they were still able to maintain their real profit margins. This leads to an important conclusion in an inflationary environment. Businesses do not only compete in products or technology, they also compete in their ability to pass costs on to consumers. The companies that can do this faster and more effectively have a higher chance of survival. Besides businesses with pricing power, another type of asset also appears in almost every monetary crisis: strong foreign currencies. When a national currency begins to lose value rapidly, the natural reaction of the market is to search for another monetary unit that is more reliable for storing value. Over the past decades, that role has often belonged to currencies considered more stable, such as the United States dollar or the Swiss franc. If we observe monetary crises in Latin America during the 1980s, we can see a very clear repeating pattern. When domestic currencies began to lose value, the group that had access to the international financial system often moved their assets into foreign currencies or deposited money in banks abroad. This allowed them to protect their purchasing power from the collapse of the local currency. Meanwhile, most of the middle class kept their money in local currency accounts, government bonds, or domestic savings funds. When the national currency lost value, the real value of those assets dropped sharply, not because they made wrong decisions, but because all of their wealth was priced in a monetary unit that was losing value. This mechanism is simple but has a very large impact. If your assets are priced in a currency that is collapsing, then the value of those assets collapses as well. In contrast, if your assets are priced in a more stable currency, you can avoid most of the impact of a domestic monetary crisis. For that reason, in most modern monetary crises, demand for strong foreign currencies usually rises sharply. People do not necessarily need to understand economics in depth to react this way. They simply realize that the purchasing power of the local currency is falling quickly, and they look for another place to store value. What is interesting is that this shift often happens before the crisis reaches its peak. In many cases, when governments begin to impose capital controls, such as limiting money transfers abroad or restricting how much foreign currency people can buy, it usually reflects that capital has already started leaving the system earlier. From a broader perspective, the two types of assets. In this section, businesses with pricing power and assets priced in strong foreign currencies share an important common feature. They do not only exist outside the weakening monetary system, but also have the ability to adjust to changes in the economic environment. They adapt to inflation instead of being destroyed by inflation. But there is still one final type of asset, often overlooked in discussions about investing and protecting wealth. What makes this asset special is that it does not require investment capital, does not depend on financial markets, and is almost impossible to confiscate or print. In many major monetary crises, this very asset has been what allowed many people to get through difficult periods without being pulled down by the collapse of the monetary system. Part 3. The final asset. The one that cannot be inflated away in the 3 previous sections. We talked about many types of assets that can survive monetary crises: productive land, gold, real estate, businesses with pricing power, and strong foreign currencies. All of these assets share one common feature: they help protect value when currency becomes unstable. But there is still one special type of asset that many people overlook when thinking about finance essential skills. During stable economic periods, we are used to thinking that fixed salaries, long-term contracts, or stable jobs are the foundation of financial security. However, in major monetary crises, that system is often turned upside down. When prices rise quickly and money continuously loses value, People with fixed income are usually the first to suffer. Their wages cannot increase fast enough to keep up with the speed of inflation. In contrast, people with essential skills have a different advantage. They are not bound by a fixed number on a payroll. They can price their work in real time. When the cost of living rises, they can adjust the price of their services accordingly. This ability allows them to adapt better in a high inflation environment. One example often mentioned in economic history is the hyperinflation in Hungary in 1946, one of the most severe monetary crises ever recorded. During that period, prices rose so fast that at times they doubled within only a few hours. People working for the government or large organizations with fixed salaries could not keep up with the speed of market prices. But skilled workers, plumbers, electricians, mechanics were still able to negotiate the price for each job. They could demand payment in goods, foreign currency, or anything that held real value. This reflects an important economic truth. When the monetary system becomes unstable, the economy tends to move closer to a form of direct value exchange. In that environment, value no longer lies in the numbers inside a bank account, but in the ability to solve real human needs. A doctor can treat illness, an engineer can repair electrical systems, a mechanic can fix vehicles. Skills like these are always in demand, no matter how the monetary system is functioning. For that reason, in many economic crises, people who possess essential skills often adapt better than those who depend entirely on the financial system. What makes this type of asset special is that it is not like any other asset. Skills cannot be printed by a central bank, cannot be devalued by inflation in the same way as money, and cannot easily be confiscated. They exist in the ability of each individual, and when the economic system becomes unstable, that ability often turns into a very real source of strength. When we look at the full picture of history, we can see a very clear repeating pattern. In most major monetary crises, the value of the economy does not disappear completely. It simply shifts from assets that depend on currency to assets that have value independent of currency. Those assets usually fall into 6 main groups: productive land, gold, real estate, businesses with pricing power, strong foreign currencies, and essential skills. Each type of asset works through a different mechanism, but all of them share one common characteristic: their value does not depend entirely on a specific currency. This leads to an important conclusion that many people overlook when thinking about personal finance. Monetary stability is not the default state of history. In many different periods, monetary systems have gone through strong fluctuations, sometimes lasting for years or even decades. What matters is not predicting exactly when a crisis will happen. What matters more is understanding which types of assets are able to survive when it does happen. When we look back at economic history, we realize that the important question is not whether major disruptions will appear in the future or not. History shows that they always appear in different cycles. The more meaningful question is a very personal one: whether the assets we hold today belong to the group of assets that have repeatedly proven their ability to survive through periods of instability. Because when a monetary crisis happens, what determines the final outcome is not how many books about economics you have read or how much financial theory you understand. What truly makes the difference is usually much simpler: what you are holding when the system begins to change.